Nigeria's capital markets are entering an interesting crossroads. Recent changes from PENCOM could reshape how funds are allocated between bonds and equities. Companies are releasing fresh earnings that are already moving the markets, and investors are trying to position ahead of what could be an important stretch for both monetary policy and market liquidity. In today's episode on The Edge, we break down what these pension reforms really mean for market demands, how local and foreign investors could access Nigeria's capital market, and which sectors are emerging as early leaders this earnings season. And importantly, if you stick around, my guest will share tactical advice on what investors should be focusing on right now and how to think about positioning in the coming weeks. Joining me today to unpack all of this is Andrew Esene. Andrew is Head Investments at FCSL Asset Management Limited. Andrew, welcome to The Edge.
Thanks, Doc. It's a pleasure being here again.
Right. Everyone, thanks again for joining us today. If you are new to this channel, please like this video and hit the notification bell and subscribe to this channel so that you can always receive our videos whenever they are uploaded. Welcome, everyone. All right, Andrew, it's been an eventful week. We saw that PENCOM reforms come through. So how significant are the recent PENCOM allocation adjustments in practical terms? Now, are we talking about marginal portfolio rebalancing or a shift that could meaningfully alter demands for equities and FGM bonds?
Okay, thanks, Doc. The recent revised guidelines from PENCOM with regards to PFA investment in the equity space is quite significant. Currently, PENCOM assets are around 26 trillion naira, and analysts are looking at about 15 to 35% increase in the allocation of those funds to the equities market. So we are looking at about 4 to 9 trillion naira additional funds coming into the equities market. So it's quite significant. And we, from the release of that information, we've already seen traction in the equities market. So that's a significant amount of liquidity coming into the equities market. It's quite remarkable.
Yeah, already we've seen that move come through. I think the all share index is up, maybe somewhere about 6 or 7%. You can, confirm whether that is true since that news broke. But so I know that PFAs are now permitted to increase their exposure to equity. So if PFAs are permitted to increase their exposure to equity, do you expect this to support valuation multiples, or would they remain selective towards only large cap dividend paying stocks? I'm talking about PFAs now, who obviously are the ones in focus.
The criteria for PFA investments, especially in the equity space, is quite it's quite steep, so to say, because these are pension assets, these are people's retirement savings, and so in investing those funds, pension fund administrators abide by strict guidelines from PENCOM on how the funds will be invested. So when they are coming into the equity space, there are guidelines as to the kind of equities that they can invest in. Normally, these are high cap liquid stocks that are profitable and have a consistent dividend history. So we will see PFAs align with that criteria and then focus on particular stocks. There is the pension index, the NGX pension index that has about 40 stocks that meet the PENCOM criteria for PFA investments in the equities market. So they would definitely align with those particular equities.
Are we seeing a possibility of those lists expanding, maybe to include additional stocks, or they're just going to be limited to those stocks that are already in the pension index, pension funds index?
Yeah, they will be limited to those stocks. Stocks that do not meet the criteria for the pension guidelines, PFAs are not allowed to invest in such equities because of the nature of funds that they hold. So, and the stocks are quite these are stocks that also meet the NGX 30 criteria, to be in that list. So just a few additional stocks added to that list, but they are the go-to stocks, so to say, when it comes to investing in the equities markets. And even when foreign portfolio investors come into the market, they are the same stocks that that meet their own foreign portfolio investment criteria.
Okay, if you're wondering what the list of these stocks are, you could check on the comment section. Later, I'll be uploading a list of those stocks that meet those requirements. So that's interesting, Andrew. Do these changes increase systemic risk in any way? For example, if pension assets become more exposed to equity volatility or duration risk in bonds, we like towing it like a really difficult part here.
Well, generally, investing in the equities market is riskier than investing in fixed income instruments because of the price volatility that we see. But I believe it's a risk that the pension funds can accommodate because, for one, they have patient funds to invest. And so, despite the market cycles, the short-term market cycles and price volatility that we'll see, they are able to stay in the market for longer and weather those cycles and those volatility. So even though there is increased risk in investing in the equities market because of the nature of funds that they hold, they can actually stay longer to reap the benefits as fundamentals improve for those companies.
Okay, that's interesting because we're already beginning to see that huge swing in the equities market because of those adjustments. Now, let's talk broadly now about the market performance this week and what we should be looking forward to in the week ahead. So the NGX has been on a tear. The all-share index up, I think, about 6 or 7% in the last week, hitting new highs around 182,000. The market cap as well, about 117 trillion. Oil and gas stocks are leading the growth. That's in the year to date, driven majorly by companies like Seplat, Aradel. Banking and industrial companies are also not left out. Obviously, earnings season is fueling this sentiment. So this week, the all-share index, as mentioned, pushed past that 182,000 amid the PENCOM news and ongoing earnings. What stood out in this price actions? It's volume spikes, sector rotations, and how much of this rally would you attribute to just the pension money flowing in versus like corporate results?
Okay, before the announcement of the revised investment guidelines, we did see the market was in we saw moderate profit taking in the market. So coming from the rally of Q4, the Santa Claus rally of Q4, the market had moderated, and we had seen some losses. Sometime last week, the market lost about 0.39%, I think on Wednesday, Thursday, and the day after it lost about 0.09%. So we had seen the market recording intermittent daily losses from profit taking. But after this news broke, we saw increased liquidity coming into the market and then pushing up prices. It may not necessarily be the PFAs that immediately started investing, but speculators will go ahead to position knowing that
Head
liquidity
of
was going to
ahead of PFA.
yeah, exactly. Knowing that liquidity was going to come in from the PFAs to push them up, and then they record that appreciation. So, though the market was in a mild profit taking, the anticipation of PFA funding coming into the market led to speculative plays, and then we are seeing the PFAs come. And when the speculators go ahead to front run the PFAs, they will target particular sectors and stocks that they know PFAs can invest in. So we've seen the likes of, like you mentioned, the oil and gas sector. It's on above 11% last week, being the best performing sector. And like you said, the main beneficiaries are likes of Seplat, Aradel, and those are stocks that qualify for PFA investments. They have sound fundamentals. We've seen increased investment in that space, and then they have they have rewarded investors consistently from their operations. And we also saw the industrial goods space pull about 7% as well. We saw gains in the likes of WAPCO, Dangote Cement, Boa Cement, then the banking sector as well. GT, several stocks are trading at their historical high levels
High
because of
levels.
this.
Andrew, I saw Seplat at about 8,600, I think on Friday. That's surprising.
Yes.
Aradel
Yes.
very close to 1,000.
Yeah, yeah. I remember when Seplat was listed
Yeah,
at around
600.
500,
Oh, yes.
569 thereabouts. The growth has been phenomenal.
I know. Let me ask, Andrew, do you see Aradel as following that path of Seplat?
So that is the expectation. People that missed out of Seplat they believe that Aradel
Is
is the
the new
compensation for that, so to say.
yes.
Exactly, that's the new Seplat. So that's why we are seeing increased positioning in that space. The word on the street was that Aradel was going to hit 1,000 naira last week. It went as high as 997, just 3 naira shy of that
Yes.
1,000 naira mark. And from what we are seeing in the new week, we should hit that particular price.
I mean, that 1,000 could be like a psychological point where investors might like, should we get there or not? And I believe once it hits that 1,000, it can always just explode from there.
Yes, because the market structure is sound. We're in an upward trend. Earnings
Yeah.
are coming in, quality earnings are coming in, and then liquidity is in favor of the equities market. So the stage is set, so to say, for the upward trend to continue.
Okay. I know you already started talking about those sectors that outperformed last week.
Yeah.
So what do this move? What do they tell us about where institutional money is positioning?
Well, it reinforces the position that institutional funds go for high liquid stocks. They
Okay.
go for stocks that have, they go for market leaders, so to say, high liquidity, so they can go in and out. That liquidity is there, that movement is there. They have not just profitability, but they reward investors. And there is also something to say for corporate governance. For foreign
Sure.
portfolio investors and institutional investors, they have their own internal criteria that they have to align with when it comes to investing. We saw the insurance space gain just by 0.65%. So it tells you that though we have penny stocks in that space and value stocks in that space, that is not
Mhm.
what the price is not what institutional investors are really looking at,
Looking
but the
forward to that.
fundamentals. Yeah. If
Yeah.
we if there's
Sorry,
a good
Andrew. Do you have any market updates on when insurance company are going to be required to recapitalize that? Is there any news? Is there any news that is already filtering to the market?
Yeah, that has already come into the market. We've seen a few issues come into the market in terms of rights issues. I know
Mm-hmm.
the likes of Universal Insurance, Suno Assurance, they've already informed the public of their pending rights issues. So that
Okay.
the recapitalization mandate is already on, and insurers are already in the market to raise additional funding for it.
Okay. Interesting. So looking ahead to next week now, as more earnings drop, what's your base case expectation? Will this momentum, do you expect this momentum to hold? Do you expect it to continue? Do you expect it to ease? Or are we due for some profit taking after such a strong rally last week?
Yeah, so there are different investors in the market with different objectives. The speculators, the short-term traders, have will look to lock in the gains that they have made, and so there might be some moderate profit taking. We did see the likes of Aradel even drop as low as 991 naira intra-week, so there was profit taking at
Those
that level.
levels.
So there will be intermittent profit taking, but PFAs don't trade short term. So when they come in, we believe the PFAs will remain invested in these positions. We're already in earnings season, and in the next 1 or 2 months, we should start seeing dividend declarations. So PFAs will remain to take those dividend declarations, and so the liquidity we are seeing coming into the market is not going to leave, in the short term. So though we might see intermittent profit taking, the funding that is coming in will remain invested in the market. Institutional investors will remain.
Okay. So here we really cater to patient capital, long-term investors. Based on this earnings trajectory that you've seen so far, which sectors look fundamentally attractive for the next quarter, and which sectors look vulnerable in your estimation?
So across sectors, the fundamentals for the sectors are improving. So if we look at the banking sector, they just raised additional capital, and deployment of that of those funds in lending and investing activities will improve their earnings. So we expect some growth from that space. The consumer goods space, they are coming out of the FX losses, and so on a year-on-year comparison basis, we are seeing growth of double, triple-digit growth in their earnings because of the base that they are coming from. The industrial goods space is also getting the benefit from increased capex from the government. So that is also helping that space. So largely across board, we are seeing that broad-based sector improvement in the sector fundamentals. Even the insurance space, we've seen the likes of NEM, Mansard, their pricing enter into double digits, and then the expectation is that with the recapitalization that is going on, they will also be stronger. They'll also be able to underwrite more risk that they currently do and improve their position as well. So across board, the sectors are either recovering from losses or they have just they've recapitalized for greater business growth. So it's really across board for the sectors.
Okay, let's switch gears now and talk about how to invest in the Nigerian capital market, because over the week I received messages, and I wanted you to kind of give us a guideline or a step-by-step approach on how to assess the Nigerian market, whether it be for local or foreign investors. So for a retail investor or someone in Nigeria today, young professional, maybe with someone with about 500,000 naira, what is the practical step-by-step process to begin investing in equities, bonds, from brokerage accounts to the CSCS registration and settlement mechanics? Can you break this down for us?
Yeah, so with the age of technology, investing in financial assets, so to say, in Nigeria has been made very, very easy. From the comfort of your home, you can approach a registered stockbroker, like FCSL Asset Management. You can approach a registered stockbroker on their web platform or on their mobile platform. You fill the account opening form. The process of opening a stockbroking account is not different from the process of opening a bank account. You just fill the application form, provide the necessary KYC documents, which include a valid means of identification, proof of address, which could be any of the utility bill that bears the address that one is looking to use, and then their passport photograph. Once that is done, the account is open for local investors. The account is open and they can trade either via the mobile platform, the web platform, or send email instructions to their brokers, and their trades will be executed. It's as simple as that. So once they open the account,
it's a seamless process. Do they have to visit physical locations of the stockbroking firm to be able to do that, or it's something you can just do from the comfort of your home?
From the comfort of your home, you don't have to leave. Not just even opening the account, but operating the account. You don't need to visit the physical premises of your stockbroker.
Oh, okay. So there you have it. If you're looking at investing in the Nigeria's capital market, it's a seamless process. And just going to any of the companies that you're looking to invest in, that you're looking for as a stockbroker, and they can guide you on how to do that. Now, let's look at someone sitting in New York, someone sitting in London or Canada or Germany. So flipping to foreign investors or portfolio managers now in the Nigerian markets. What's the playbook like? From the FPI registration, getting a certificate of capital importation, to navigating CBN FX guidelines. Can you talk more about this process?
Okay, the major difference from local investors and foreign investors accessing the market is really in terms of the capital certificate of capital importation, and then the KYC requirements. So for foreign investors, for foreign individual investors, the process is the same, but those KYC documents will have to be notarized because they are not based in Nigeria. So to authenticate those documents, they have to be notarized. And then after the account is opened, in terms of funding, so the funds are transferred to their bank, and then the bank issues the electronic certificate of capital importation. They don't need to deal with the CBN. The authorized dealer.
Can you take that again? It is the bank that issue the certificate of capital importation, not the CBN.
Yeah. Okay. Yes, their banks will issue it to them and report to the CBN the details of that transaction, so to say. So once they open the account, they make the transfers dealing with the banks will issue the ECCI, knowing that this is a foreign client. What the ECCI does, the electronic certificate of capital importation, it does is that it gives the legitimacy for those funds to be repatriated after those assets are liquidated.
Okay,
so it's really the same process. But for most foreign portfolio investors that are institutional, then there are additional requirements like a board resolution, that is required to operate the accounts, and then having that additional documentation in terms of signatories, a formal application that needs to be done. But it's really the notarization of documents and then the CCI requirements that separates local and foreign investors.
Okay, so thanks for providing that insight. So to anyone looking to access the Nigerian capital market, whether you sit in the comfort of your home in Lagos or you are in London, it's a similar process. The only difference is if you're a foreign investor, you need to obtain that certificate of capital importation, and that's something you can do through any of the Nigerian banks. Okay, let's switch to where we draw from your experience now, talking about tactical advice now. So with inflation trends, the MPC expectations, and fiscal borrowing still in full play, obviously, we've seen that 2026 budget and how much the federal government is looking to borrow. How should investors think about the balance between equities and fixed income over the coming weeks?
Well, for the coming weeks, we expect the largely bullish trend to dominate trading activities with intermittent profit taking. So the
Okay.
equities market should continue in this bullish trend. For the fixed income market, we are expecting a monetary policy committee meeting by the end of this month.
Yes.
And the general expectation is maybe we'll likely see a moderate cut in the key policy rate.
Okay.
Yeah, and that is the anchor for fixed income rates. But for interest rate generally. But the concern is really that given the deficit in the budget and the increased activity from the government, we know that they will be actively borrowing in the market. That is an incentive for a cut in rates to reduce their cost of funding. But also the CBN is also watching that to see that increased borrowing would also lead to increased spending, just to ensure that we don't have another case of
inflation
pressures, on the inflation side. So what the MPC would do is likely, there has to be that balance in trying to reduce the high MPR rate, the monetary policy rate, and also ensuring that we do not cause a situation where there's an increase in liquidity liquidity in the system again to force inflationary pressures. So
sorry, go ahead.
Yeah, so for the equities market, the outlook is positive. It's bullish. Cause for a balance of that, I would say we are largely overweight on the equity side more than on the
fixed income. Okay. I know that the inflation figures are expected, where I think the general expectation is that it's likely going to inch up, not because of seeing increase in the baskets that make up the inflation, but because of a technical adjustment, because of the base effect. So there is an expectation that inflation in January might go up. So whether that is enough or whether that's enough for the MPC to say on the basis of that rate inflation going up, they are not going to want to reduce the rate. So it's something that we are going to be watching out for. So I did say that for our listeners and for people watching this program, that you're going to be providing that advice, what investors should be looking at right now. So for investors entering the market now, should they stage into positions gradually, focus on high quality dividend names, or lean into sectors showing earnings momentum?
Well, you really don't want to, for new investors, you don't want to chase prices because, like I said, there would be intermittent pullbacks. So it is best to do one of two things. It's either you want to wait for the pullback, and then position, in sound quality names, and then position in those names that you're looking at, buy on the red days, so to say, or you can phase in your entry, like you said, stagger your entry into the market. So if you have 100% of funds you want to put into the market, you could go in with 25% on the target names that you are looking at, just so that you have a foot in the door, as prices continue to appreciate. If the prices go higher, you have one foot in, maybe 25 or 30% of the investment is already in. And if prices come lower, you still have the firepower to average down on those positions and increase your holdings even at a lower price. So that's what investors should look to do. It is not advisable for retail investors to chase prices because you may just be the one holding the short end of the stick at the end of the day. Speculators will be selling at those high prices, and if you're chasing them, you will be buying at those high levels, and before you know, we may just see a moderation, a stability in the prices, because the funding that is coming from the PFAs is what you want to call smart money, right? They are not just going to keep chasing the high prices. Some of them will come in with the funds but can cap the prices and say, okay, we don't want to buy Aradel above 1,000 naira, so get it for us below 1,000 naira. If the retail investor has gone ahead to chase the price and buy above 1,000 naira, nobody's taking it off you at the other end. So you want to go into quality names, but you want to either have a foot in the door or you wait for a pullback before you position. Generally, I prefer to, because the equities market there's a random walk theory in the equities market, that you never know where prices are going to go next in terms of price action. I would put a foot in with 25-30% of what I want to invest, and then watch how.
Because I was going to say that could it be possible that this is the lowest we'll see for the year? I mean, no one knows.
That's true. With the amount of liquidity coming in,
yes,
that's a possibility. But the next 10 months is a long time for for the market, and the market could pull surprises. Really.
Yeah, I'm in agreement with you there. So, what's the single biggest mistake? Obviously, with all you've said now, what's the single biggest mistake investors should avoid in this current environment, this current earning season, all the momentum, the hike in prices? What's one mistake that investors should avoid at this time?
There's always this hype when the market is going up. The market returned about 52% last year.
Yeah.
And so people that missed out of that have come in, and they want to make the gains that they didn't make last year. So there's the temptation, there's a tendency to jump in with the bandwagon and just jump into the market, buy anything, so to say. I think that is one mistake that investors make in a bull market. You just want to jump in. You just believe that as long as the benchmark index, the all share index is going up, it means all
stocks are going up.
That's not the case. So it's better to go into the market with professional guidance, sound research, and to also know that the equities market is a long-term market. It's not a short-term market. There's a possibility to make short-term gains, but that's not why you trade the equities market. It's a long-term market. Over time, the market does well, does better in the long term than what you record in the short term. So the single biggest mistake I would say is jumping on the bandwagon without proper research and professional guidance in the equities market. Like they say, a rising tide lifts all boats, right? But when the tide starts coming down, we then see the boats, the companies in this case, that can weather the storm.
Wow, that's an insightful one, and I think it's a good place for us to end our discussion. So, our listeners, thank you for joining us. Let us know in the comment section which stocks you are going to be looking to purchase today, or which sectors you are going to be looking to invest in. Please share whatever investment strategy you have on the comment section. We're trying to build wealth together this year. Andrew, thank you for your brilliant and insightful analysis as always. Do you have any final words?
The equities market is the market generally is a place for wealth creation. Just come to the market with the proper mindset, and you will do well.
Thank you so much. Been my pleasure having you today again on the platform. Thank you.
Thank you. Same here, sir. Thank you.
All right.
Bye.
Bye, everyone. We're out.